Not being a Fed watcher, I've been rather slow to this particular narrative, I'm afraid. And it only really dawned on me last week as I was losing money trying to catch falling knives in the stock market. And it was Zoltan Pozar, writing for Credit Suisse, who switched on the light bulb for me. He's the new institutional market strategist, rock star. But a couple of other analysts have reached the same conclusion, and it is this. The Federal Reserve and America's other policy-making powers that be actually want the stock market lower. Now, I know that sounds absurd, not in the long term, but just in the short term. I've heard so much hot air coming out of government officials' mouths over the years that I think my mind is actually programmed now to not believe a word they say. It's not that I'm treating what they say with a healthy dose of cynicism. I've reached unhealthy doses of cynicism, unhealthy levels. My default, so low is my trust, is now not only not to believe a word they say, it is to assume they are lying. Probably not a good place. And it turns out that sometimes those in power do actually tell the truth. I got my first surprise dose of this earlier this year from Foreign Secretary Liz Truss when she warned that the Russian troops on the other side of the Ukraine border were about to invade. I was, pull the other one, I thought. There's no way Russia would do anything like that. And it turned out that Truss was talking straight and that her intelligence was correct. And when US President Joe Biden said his top economic priority was getting inflation down, my inner cynic muttered, yeah, of course it is, mate. And it turns out what he's saying might actually, believe it or not, be true. The Federal Reserve's primary mandate is to keep inflation down. It might be that the chief, Jerome Powell, is taking this mandate at face value. And all that stuff about his hero being Paul Volcker might even be true too. Lower asset prices help the cause. Back in 2008, and for many years since, everyone in policymaker land was worried about deflation, and every effort went into staving it off. So we got quantitative easing, ZIRP, zero interest rate policy, and all the rest of it. We got very used to it. It went on for so long it became normalised. The idea that they would ever do anything else seemed far-fetched. But no, in policymaker land, they are genuinely worried about inflation, as are we all. And so asset prices are not going to be defended. Au contraire, they want them to fall a little bit. Bear markets mean financial conditions tighten. Tighter financial conditions mean lower money velocity and lower inflation, according to modern definitions at least. The Fed is talking tough, and it might be that talking tough does a lot of the job for them, and they might not actually have to act as tough as they talk. If they can get stock prices down a bit, house prices down a bit, a lot more caution around the place, with just a bit of jawboning, then the need for higher rates will diminish, and the Western world might not actually implode. Falling crypto markets help the cause too. There won't be that particular thorn in the federal side exposing the shortcomings of fiat money. Tighter conditions will put some upward pressure on unemployment, which means the upward pressure on wages will go away too, and that will help reduce wage inflation, another form of inflation. If this has to happen sometime, that time is now. In the second year of an election cycle, come 2023, the priority will shift to getting the economic conditions in place to win the next election. And part of this, of course, is lower inflation, but they will want the correction in the past and asset prices moving back up again. Okay, so if you buy this theory, how far do stocks fall? How low can the S&P go? Currently, we're at about 3,950, 4,000, having been as high as 4,800. So we're off 15% or so. Another 15% take us to the low 3,000s. Best case scenario, I'm going to say 3,600. That's the post-corona panic high. Worst case, down around 3,000 at the 2019 highs. Most likely, I'm going to guess somewhere in the middle, 3,400, the pre-2020 lockdown high. But the bottom line is this: the print money and protect asset prices at all costs narrative has gone. It's history. The issue is no longer deflation, by their definition. Now it's about inflation. They've been able to ignore it for years by crooked measures, ignoring asset prices and all the rest of it. They can't any longer, and that's what they're now fighting. As they say, don't fight the Fed. Won't be the case forever. The elections have to be won. But it seems the case for now. Psychologically, we might need some despair and maximum pessimism before the bear market can be deemed over. There still does seem to be a little too much optimism about. We need to be at that point that the perception that the bear market is entrenched and we're never going to get out of it. That's what a full-on bear market is like before it can end. We don't seem to have reached that point yet. Everything bubbles on the way up, everything pops on the way down. And it might be, by the way, that UK stocks and small and large turn out to be a very good place to hide. I'm not saying the UK economy, stock markets and economies are very different, but I saw this very interesting presentation by fund manager Gervais Williams at the UK Investor Show last weekend, and UK stocks have been rubbish for about 20 years, but in the inflation of the 70s they were one of the best places to park capital globally, and fingers crossed the same thing happens this time around. Anyway, thanks very much for watching. I'll be back with another video very soon. In the meantime, subscribe to the channel, look out for my Substack, and enjoy the view. Oh, well, that's not a particularly nice view. There you go. Enjoy the view of the, in fact, that way's nicer. Enjoy the view of the Oxford canals. Alrighty, cheerio.